you've spent 30 years building this incredible business empire in South Africa.
Right. A lifetime of work.
Exactly. You know, you've accumulated commercial properties, you've built up these substantial cash reserves, and maybe you've developed some highly valuable intellectual property.
Yeah.
And you've placed all of this wealth into what you believe is a totally secure vault.
But you haven't.
Right. According to the source materials we are analyzing for today's deep dive, you've likely left the vault door completely wide open.
Oh, absolutely.
And not just open, but like you put a neon sign outside pointing right to the cash.
Yeah, it really sounds counterintuitive, given how protective entrepreneurs generally are of their businesses. But the financial architecture that most founders use is it's fundamentally flawed from day one.
I mean, I was going through these materials on family trust income streams,
Yeah.
specifically the frameworks designed by Lumke Sturma.
Right, the South African trust consultant.
Yes, exactly. And it really hit me. If you are a business owner listening to this right now, you are likely exposing yourself to catastrophic, like existential financial risk simply because of how you structure your ownership.
It's scary how common it is.
Because we tend to hold our most valuable assets either in our personal names or directly within our active trading companies.
Which is, that's the default setting for almost everyone, right? You start a business, the business needs a warehouse, so the business buys a warehouse.
Right.
Or you buy it in your own name and run the business out of it. But an operating company, a SUDI LTD, is out there on the battlefield.
Yeah, taking all the hits.
Exactly. It signs contracts, it hires employees, it takes on debt, it deals with suppliers. So because it operates in the real world, it inherently carries risk, like every single hour of the day.
So if you hold your wealth in that exact same entity or, in your personal name while you are signing personal sureties for that business, you are literally linking your safest assets directly to your riskiest operations.
You're tying them together.
One bad contract or a really aggressive SARS audit or just a lawsuit from a supplier, and boom, it can trigger a liquidation.
And that's all gone.
The business fails, and it drags your family's entire net worth down the drain with it.
Yeah, the problem we are identifying here is what I like to call the illusion of separation.
Okay.
Entrepreneurs think, well, because the business is a registered company, I'm personally safe.
Right, the corporate veil.
Exactly. But if all the real value is trapped inside that risky shell, that corporate veil won't save the assets. Sturman's framework, which she calls the asset protection fortress, it actually solves this by mimicking the exact legal architecture that ultra-wealthy families have utilized for generations.
Okay, let's unpack this a bit, because the core mechanism she advocates for is this absolute separation of ownership from risk.
Yes.
But how do you practically do that if the business still needs those assets to survive? Like, if my business relies on a specific piece of custom manufacturing equipment, I can't just, hide the equipment away in a vault.
Well, you don't hide it, you just change who holds the title.
Oh, I see.
Think of your wealth like this glowing digital fortress. The operates company is positioned completely outside those fortress walls.
Out on the battlefield.
Exactly. It trades, it takes on the daily risk, but it does not hold the title to the most valuable assets. Your family trust quietly and securely owns those assets, totally safe behind the fortified walls.
Okay, I want to make sure I grasp the mechanics of this.
Yeah.
So let's say the trust owns a commercial building.
Okay.
Does the trust then just, let the business use it for free?
No. It has to be a formal arm's-length commercial arrangement.
Right.
The trust owns the building and signs a legitimate commercial lease agreement with your operating company. So your operating company pays market rate rent to the trust every month.
Ah, so the business still has complete access to the building it needs to function.
Exactly.
But if the business gets sued or liquidated, the attackers are looking at an entity that just leases its premises. They can't touch the actual property because the business doesn't own it.
The trust does.
Wow.
That is the firewall. You still exert control over the entire ecosystem through your roles. You are the director of the company and you're a trustee of the trust.
Right, so you're still the boss.
Exactly. But your personal liability and the ultimate ownership of the assets is completely shielded from those commercial risks of your daily operations.
Okay, so a fortress keeps the bad guys out. That makes sense.
Yeah.
But if you just lock all your capital in a dark room, inflation is going to eat it.
Oh, for sure.
It stops growing.
Yeah.
So how do we put those protected assets to work without, exposing them to the battlefield again? Because from what I read in the sources, taxation on trusts in South Africa is notoriously aggressive.
Oh, it is incredibly steep.
Yeah.
To understand why, we really have to look at how the South African Revenue Service, or SARS, views a trust. A trust is not a human being, it's a legal fiction.
Okay.
And SARS generally prefers to tax warm bodies. They do not want wealthy families hiding their capital inside this faceless entity just to avoid personal income tax.
That makes sense.
Right. So to discourage people from just parking money in a trust indefinitely, SARS applies a flat, punishing tax rate of 45% on any income retained within the trust.
Wait, a flat 45%?
Yep.
There is no progressive sliding scale like we have with individual income tax?
No sliding scale at all.
Okay.
From the very first rand of profit that you keep in the trust, SARS takes 45 cents.
That is wild. So if I leave the money in the trust to protect it, I am basically volunteering to hand over nearly half of my yield to the government.
Pretty much.
I mean, that completely kills the compounding effect of wealth creation. There has to be a mechanism to bypass that penalty, or no one would ever use trusts, right?
Well, there is a mechanism, and it's basically the foundational pillar of trust tax strategy in South Africa. It's called the conduit principle.
The conduit principle, okay.
Yeah, because a trust is a legal fiction, South African tax law allows it to act as a transparent pipe or, a conduit. If the trustees receive income, let's say rental income from that commercial building we talked about, and they formally decide to distribute that income to the beneficiaries within the same tax year, the income flows straight through the trust without being taxed at that 45% rate.
Oh, okay. So the trust doesn't actually pay the tax. The beneficiary pays the tax.
Correct. And here is where the strategy really solidifies. The beneficiary pays the tax based on their own personal marginal tax rate.
Right.
Furthermore, the income retains its original nature. So if it went into the conduit as rental income, it comes out of the conduit and hits the beneficiary's tax return as rental income.
Wow. So you're essentially utilizing the lower tax brackets of your family members to reduce the overall tax burden on your wealth.
Exactly.
I want to bring this abstract tax law to life with an example from our source material. There's this case study, the Morrison Family Trust.
Oh, yeah, that's a great one.
It really highlights the mechanics of this conduit principle.
It's a textbook application of shifting the tax burden to the most efficient environment.
So the Morrisons hold residential investment properties worth about 8.5 million rand inside their trusts. And after paying all the rates, the maintenance, the bond costs, the trust generates a net rental profit of 384,000 rand for the year.
Okay.
Now, if they just leave that cash sitting in the trust's bank account, it gets hit with that 45% flat rate.
Which would instantly wipe out 172,800 rand of their profit.
That is painful.
It's a massive drag on their property yield.
But instead, the trustees use the conduit principle. They distribute that 384,000 evenly to the three Morrison children. So each child receives 128,000 rand.
Right.
Because these kids are young adults with their own individual lower income tax profiles, they fall into the 31% tax bracket, not the trust's 45% bracket.
Exactly.
So by making that strategic distribution, the family saves 53,000 rand every single year in taxes.
And if we project that over a decade, accounting for rental escalations, that is well over 500,000 rand that stays within the family's ecosystem, simply because they understood how to legally route the money.
That is incredible.
But rental property is just one asset class. The sources also highlight dividend income, which operates under slightly different rules and is actually even more powerful funding specific family goals.
Yeah, I saw the Henderson Investment Trust example in the notes, and it struck me because the way dividends are taxed in South Africa seems totally divorced from that conduit principle we just talked about.
Yeah, you've hit on a major distinction in the tax code there. Dividends in South Africa are subject to a final dividends withholding tax at a flat rate of 20%.
Okay.
And the key word there is final. The company paying the dividend withholds the 20% and pays it directly to SARS before the money even reaches the trust.
Oh, I see.
Because that 20% is considered a final tax, it doesn't matter if the trust retains the dividend or distributes it to a beneficiary. There is no additional 45% trust tax, and there is no personal income tax layered on top of it.
Wait, really? So once the 20% is paid at the source, The remaining cash is completely clear of any further tax liability, no matter where it flows inside the family structure.
That is the beauty of it. Let's look at the Henderson Trust. They hold a 6 million rand share portfolio.
Okay.
It generates 240,000 rand in gross dividends. The companies withhold the 20%, so the trust receives 192,000 rand in clear post-tax cash.
Wow.
The trustees then use that exact amount to fund the education of 4 grandchildren, allocating 48,000 to each child's tuition.
And those grandkids don't have to declare that 48,000 is taxable income.
They do not. The tax was already settled. It's a perfectly optimized, frictionless education fund operating right from behind the safety of the fortress walls.
That really expands the definition of what a trust can be. It's not just a vault for a family home, you know.
Definitely not.
The sources rapid fire through several other income streams, too.
Yeah.
We talked about commercial property leases, but you can also hold intellectual property,
Oh, yeah.
like the Thompson Brand Trust example. That was fascinating. They actually transferred the trademarks and the branding of the family's retail business into a trust.
Let's look at the mechanics of that because it's brilliant.
Huh.
The trust formally registers and owns the trademark.
Huh?
The operating retail business, which is taking on all the commercial risk out on the battlefield, signs a licensing agreement with the trust to use that brand.
Right.
The operating company pays a 3% royalty on its gross turnover directly to the trust.
So the operating company gets a legitimate tax deduction for paying a business expense, the royalty, while simultaneously moving cash out of the risky corporate shell and into the protected trust environment.
Exactly. And then the trust can apply the conduit principle to distribute that royalty income to beneficiaries in lower tax brackets. It is a highly sophisticated method of extracting value from an active business.
It even applies to farming, which blew my mind. The Vandermerwe Agricultural Trust runs a cattle and grain operation.
Right, and farming profits can be incredibly volatile.
Exactly. So by spreading their 800,000 Rand annual farming profit across 3 generations of beneficiaries like the grandparents, the parents, and the adult children, they dropped their effective tax rate to 28% instead of the 45% trust rate.
Wow.
Yeah, saving 130,000 Rand a year.
It really illustrates that any income-generating asset can be optimized if the legal architecture is sound.
Absolutely.
However, hearing all these benefits, it is very, very tempting for a proactive business owner to think, hey, I can just download a generic trust deed template from the internet, register it with the master of the high court, and start moving my money around to save on taxes.
Oh, we see that all the time. It's that classic DIY entrepreneur mindset, right?
Yeah.
Why pay a specialist when I can build it myself?
Exactly.
But if setting up a trust is like building a custom house, doing it yourself without understanding South African tax law is like building a house without checking the zoning laws.
That's a great way to put it.
It might look fine on the outside, but the moment an inspector comes by, the whole thing gets bulldozed.
That is such an apt comparison because SARS acts as the ultimate building inspector, and the penalties for non-compliance will financially dismantle you.
Yeah.
The source material actually outlines several disastrous yet incredibly common mistakes people make when they try to DIY their trust management.
Let's dig into the specifics of those hidden landmines, because I guarantee someone listening to this deep dive right now is currently falling into one of these traps.
Okay, well, the most prevalent trap is Section 7C of the Income Tax Act.
Section 7C, okay, what is that?
Historically, wealthy founders would set up a trust, and because the trust obviously had no money to buy assets at first, the founder would simply give the trust an interest-free loan.
Right, makes sense. It's their money.
It was a massive loophole. You could move millions of rands of growth into a protected vehicle without triggering any donations tax.
So SARS obviously caught on to this and closed the loophole.
Aggressively. Under Section 7C, if you provide a low-interest or interest-free loan to a trust, SARS intervenes. They calculate the interest you should have charged the trust based on the official repo rate plus a margin.
Okay.
They then treat that imaginary foregone interest as a deemed donation.
Wait, explain that to me like I'm 5. Because that sounds wild.
Sure.
If I loan my own trust R1,000,000 Rand just to help it buy its first property, and I don't charge interest because, well, it's my family's money, SARS imagines I made interest anyway.
Yes, exactly. They look at that 1,000,000 Rand and say, at current official rates, you should have charged the trust 80,000 Rand in interest this year.
Oh, no.
Because you didn't charge it, SARS deems that 80,000 to be a donation you made to the trust.
Wow.
You are then hit with a 20% donations tax on that imaginary $80,000 payable every single year the loan remains outstanding.
That is just wild.
Hmm.
You think you're being clever by lending the trust some startup capital for free, and suddenly you have created a recurring annual tax penalty for yourself.
And that's just one section of the tax code. Another massive pitfall is the mishandling of the conduit principle through artificial distributions.
Okay, let me push back on the conduit principle for a second.
Go for it.
We established earlier that I can distribute the trust's rental income to my kids so they pay the lower 31% tax rate instead of the trust's 45%.
Correct.
What if I just do it on paper? Like, can't I just tell SARS in the tax return that I distributed the $384,000 to the kids, but actually keep the physical cash sitting in the trust's bank account to build up capital for the next property?
No, and attempting that will trigger severe consequences. SARS operates on a doctrine of substance over form. They are explicitly on the lookout for artificial manipulations. For a distribution to be legally valid for tax purposes, it must be genuine. The beneficiary must gain a vested, unconditional right to those funds.
So I can't fake the paper trail? The actual movement of money has to match the resolution.
Exactly. If you declare a distribution on paper, but the beneficiary never actually receives the economic benefit, or if you force them to immediately loan it back to the trust on terms they didn't agree to, SARS will see right through the form and look at the substance.
And then what happens?
They will disregard the distribution entirely, hit the trust with the 45% tax rate, and likely apply underestimation penalties and interest on top of that.
Yikes. So you really cannot treat the trust like a personal piggy bank or some accounting fiction. It has to operate as an independent entity.
And if you fail to treat it as an independent entity, you run headfirst into the Section 7 attribution rules.
Which are what exact?
If a founder maintains too much personal control over the trust assets, like if they use the trust's bank account to pay for their personal groceries or holidays, SARS can invoke Section 7 to pierce the veil of the trust.
Meaning they look right past the fortress walls?
They tear the walls down. Under Section 7 attribution, SARS can decree that because you never actually relinquish control of the assets, the income generated by those assets is attributed right back to you, the donor, in your personal capacity.
Oh, wow.
You lose all the tax efficiency of the lower beneficiary brackets, and worse, you lose the asset protection because the assets are deemed to be effectively yours.
So the inspector found the zoning violation and bulldozed the house.
Precisely.
The stakes are simply too high to wing it. Which brings our focus back to Lumka Sturman's approach to solving this.
Yeah.
Looking at her materials, her role as a trust consultant isn't about just filing a generic document with the master of the high court.
Right. I mean, a standard attorney can draft a basic trust deed, but a document is not a strategy. Sturman's methodology is about architecting an ongoing SARS-compliant ecosystem. She focuses on how the assets flow, how the income is taxed, and how the administration holds up under scrutiny.
Yeah, what stands out in her materials is the structure of her frameworks. She doesn't operate on an open-ended hourly billing model, which usually terrifies business owners.
Definitely.
She uses specific diagnostic tools. For example, she outlines something called the foundation audit. It's priced around 25,970 Rand, and it basically acts as an exposure risk analysis for business owners.
And the methodology of that audit is crucial. It forces the founder to map out exactly where their personal liabilities intersect with their business liabilities.
Right.
Are there commingled funds? Are there personal sureties signed for business overdrafts? It assesses whether the client's current financial behavior actually warrants a trust structure or if they need to clean up their operations first.
It's a diagnostic tool to prevent you from building a fortress on a swamp.
That's a perfect analogy.
And for founders who are ready to build, she uses the Asset Protection Blueprint session, which sits around 39,990 Rand. This framework maps out the exact step-by-step separation of ownership and risk that we discussed earlier.
Yeah.
It answers the specific how. Like, how do we legally move the commercial property out of the pre-TL LTD and into the trust without triggering massive capital gains tax events?
It provides the architectural plans, but equally important is her emphasis on the annual Fortress Review. A trust is not static. You know, tax codes change. As we saw with Section 7C, family dynamics change, children grow up, people get married, the compliance requirements are constant.
Her core philosophy really seems to be that an educated trustee is a compliant trustee. She's in hiding behind dense legal jargon to make you permanently dependent on her firm.
No, not at all.
She wants clients to actually understand the mechanisms we've covered today. So if you are a business owner out there generating income and acquiring assets, and you want to understand these frameworks better, you can explore her educational resources, book a consultation, or get her book by visiting her website at www.lumkasturman.com. It is fundamentally an investment in ensuring your legacy survives your operational risks.
Absolutely. Because if we connect all of these technical tax and legal concepts to the bigger picture, a family trust is a living financial entity.
Yeah.
It takes the active, stressful, and inherently fragile success of your current business and transubstantiates it into stable, multi-generational wealth.
So to sort of synthesize the mission of today's deep dive, building wealth in South Africa really requires a dual strategy. First, defense. Separating ownership from liability is the non-negotiable foundation.
Right.
Your operating company takes the daily risk on the battlefield, while your family trust securely holds the core assets behind the walls. Second, offense.
The fun part.
Yeah, the fun part. By utilizing the conduit principle and structuring diverse income streams like property leases, dividends, and royalties, you can legally optimize your family's tax burden, turning a passive vault into an active compounding engine. But this entire structure relies on meticulous, absolute compliance with SARS regulations.
Exactly. You cannot fake the paperwork, and you cannot retain personal control over trust assets without facing severe consequences. The legal boundaries must be respected.
Which leaves you with a final, lingering thought to mull over today. If you are a successful entrepreneur, you are likely spending almost all of your time, stress, and energy right now building your active business.
Yep.
But decades from now, when you eventually step away and the dust settles, what if your greatest, most lasting financial achievement isn't the operating business you built, but the invisible, indestructible fortress you built around it? Keep building and make sure you lock the vault.